Hello, everyone. I think we had like two great talks. So my name is Sankha Banerjee, and I'm the Chief Protocol Economist at Babylon. So I'm going to present the motivation for Bitcoin staking, and I think my talk is very well placed just after EigenLayer to kind of see some of these other visions of staking and restaking in the other ecosystems. So quickly, because we are in ETHCC and at Babylon, what we are trying to bring is we are trying to bring this staking landscape to Bitcoin. And it's a pretty 0-to-1 initiative for Bitcoin because as we know, like Bitcoin is a proof of work chain. So when you say that you're bringing staking to Bitcoin, it sounds like a little bit of like an oxymoronic statement. So one of the things which we would like to do is we'd like to benchmark some of the learnings from Ethereum as Ethereum has gone from proof of work to proof of stake. So we are at ETHCC, and one of the things we want to understand is Ethereum has actually transitioned from proof of work to proof of stake. And two of the major events in the Ethereum was the merge and the Shanghai upgrade. So the merge made Ethereum move from a proof of work to a proof of stake chain. And this curve on the right side is a very interesting curve. So when you kind of launch a proof of stake chain, as a protocol, you're very concerned that is most of the supply in the circulating supply getting absorbed in staking. As a result, it creates a massive liquidity issue for the chain. So right when Ethereum transitioned from proof of work to proof of stake, Lido launched STETH. And that STETH got launched in Curve and Balancer. So there was an increase in liquidity also as the staking was getting launched. So it was a very interesting exercise that you're using security bootstrapping, but at the same time, you're launching liquid staking to help the liquidity aspect of it. Then Shanghai upgrade came, and there was the withdrawal of ETH, which was allowed. If you're a proof of stake chain and you're allowing liquidity to leave your chain, you're very concerned that does that impact the security of the chain? But what that helped was the liquidity allowance helped institutional investors understand that, sorry for that, help institutional investors understand that Ethereum is very confident in allowing withdrawal, and as a result, what it helped was more liquidity came into ETH. The ETH rewards were actually spun up as nodes, and as a result, STETH became accepted as a collateral on lending platforms. So what you're seeing here is Ethereum transition from proof of work to proof of stake. You had the launch of the liquid staking industry, as well as you got liquid staking tokens accepted in lending business. So you're seeing a bootstrapping of security actually helping the liquidity side of the blockchain too. So when you have staking, on the left side of the picture, staking positions or AVS staking, these are non-fungible positions. There are no liquidity. There's a loss of capital efficiency. So when you see this liquid staking as well as liquid restaking comes, what's basically happening is your security bootstrapping. If you carefully financially engineer these positions, it actually helps increase the liquidity of your system. And as you see, it increases the liquidity of the system. These liquid stake tokens get accepted as collaterals, and they have been able to do multiple different activities. So you see the risk preference of a sorry for this, the risk preference of a participant go a lot more, as well as you have a much bigger diversified set of risk exposures coming from lending, arbitrageurs, perps platform. So what did we learn from these two activities? That if a blockchain transitions from proof of work to proof of stake, specifically in the case of Ethereum, it created the liquid staking industry, it created the liquid restaking industry. EigenLayer came in to give leverage to these stakers. So as a result, you have security bootstrapping, amplifying liquidity inside the system. And that's very evident when you look at this table. So when you see what Ethereum has generated as fees, and then when you see what Ethereum has given out in validator rewards, if you subtract that too, that's called the economic balance of the protocol. What we see is Ethereum and Binance Smart Chains, these are positive economic balance protocols, but you see these other chains, the big chains, Polygon, Solana, and Cosmos, they are negative economic balance systems. So the natural questions comes out is, does these chains pay a lot more for their security when the economic activity inside these chains are not that big? So let's stand here, and so what is the rationale of Bitcoin staking? We're bringing staking in terms of Bitcoin collateral to these app chains to try to fix the economic balance of these systems. Let's give an example. So imagine you're running a company and you have to raise money. Initially, you go back to the venture capital, you raise money by shelling equity shares of your company, but at a certain point, you want to have a choice between the debt and the equity. So the way we are positioning ourselves in Bitcoin staking is we want to give you this Bitcoin collateral that as a protocol, you have the chance of choosing the issuance being given in terms of native token or the issuance being directed to Bitcoin capital. So we're looking at every protocol with negative economic balance to try to fix the protocol structure, which is a combination of debt and equity. So I want to give an example of why this is so important from traditional market. So there are high inflation countries in the world, specifically Argentina, which wanted to do restructuring of the debt. And when they launched these debt bonds, they launched it in dollars. These are dollar-denominated bond, which was allowed to do the restructuring of the sovereign debt. And the reason the investors came in is they don't want the debt to be structured in a high inflation country currency. They want to take on that debt so that that debt is priced in a liquid asset like dollars. So for us at Bitcoin staking in Babylon, we're actually giving the protocols and the protocol founders a choice of issuing their issuance in terms of Bitcoin because we think it's the most liquid and it's the most stable assets. So that's where the security bootstrapping with Bitcoin is so important. But then when we come to the app chains, we also find that there's barely any Bitcoin liquidity in the app chains. So the idea which we're trying to do is we're trying to bring staking for security bootstrapping, but we're also trying to bring liquid staking to help with the liquidity of Bitcoin in these chains. So one of the big things why this is clicking and why we seem to have gotten some momentum is Bitcoin has been the top performing asset for this year, as well as we have seen the Bitcoin ETFs coming in, which has given a run for the money to the gold ETF. So what's that's happening is that's, sorry for that, that's bringing the institutional investors to accept Bitcoin, and people are buying Bitcoin not just for the price aspect. They're buying Bitcoin because they think it's going to be the next digital, if not already has become an alternative for gold, and it's digital gold. However, as we look at the Bitcoin ecosystem, one of the issues which we see is that Bitcoin does not really have a native yield opportunity. If you look at the lending protocols which gives out these lending yields, there's barely any native yield given to Bitcoin. So that's where the trustless staking from Babylon, where we're trying to map Bitcoin collateral to get native yield from these POS systems which have negative economic balance. So we are trying to give a dual-sided marketplace where you onboard Bitcoin as a staking capital and you're getting native yield in terms of these POS tokens which have negative economic balance. So I want to go a very high level that what is Bitcoin staking. So we have actually four parts. So we have the Bitcoin staking, where the user comes, locks the Bitcoin on the Bitcoin chain. It never leaves the Bitcoin chain. Then that dollar strength gets transferred to Babylon chain, which is the first AVS on our protocol. And then Babylon is a Cosmos SDK chain. So it's IBC enabled, and you can actually do restaking with other POS chains. As a result, the Bitcoin holder gets Babylon tokens, as well as the new chains like Cosmos Hub. We are also doing partnerships in the roll-up space. So there's a lot of different yields which you can get as a Bitcoin staker. And so we have been very successful in kind of incubating a growth of ecosystem partners who are building with us. And these are L1s. These are also decentralized physical networks. There are a lot of DeFi protocols which has moved in. The major focus is, can we give an alternative to protocols rather than just issuing their native token? They can also come in to use Bitcoin stakers as a choice of capital. So I would invite everyone to come and build with us, and thank you.